This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
5 out of 5 for the Jason Hartman podcast. Thanks to his teachings, I have no worries about my future. My future is bright, and that for my family. I recommend the Jason Hartman team to anybody who is interested in financial freedom by way of real estate investing. 5 out of 5.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1757. Like I've said before, I can't wait till we get to episode 4352. That'll be a special one. Just kidding. I'm just picking a random number out of the air, by the way, there. But yeah, it's just amazing to have such a long-running show and so many great listeners, and listeners in 189 countries. I mean, wow. Thank you all for listening from all around the world. And we try to be global in our viewpoints so that the content is interesting to everybody, even if they're outside of the U.S., outside of North America. And glad you tuned in. You know, I remember when I was a kid, I bought at a garage sale an old shortwave radio. I mean, it was this, I don't know, I wish I still had some of that stuff, you know? Maybe it's somewhere in my mom's house. I don't know, probably not. I remember just sitting there listening to that, especially at night when I was in bed, and I'd, you know, tune in these radio stations from all around the world, from Asia, from Russia, from Europe, places that were totally exotic to me, and I just would listen to the people. Sometimes I'd even listen to them talk in other languages. It was so fascinating. But now, today, the world has become such a small place. Even if you haven't done a lot of traveling, I know you all feel that the world is small. I remember in the old days of real estate, it was rare when someone would leave a phone number, or I would leave a phone number for somebody else, to give them an area code. You know, that was just something you wouldn't do. I mean, it was unusual to deal with anybody outside of your telephone area code, much less out of the county or out of the state. And now it's just normal. Most all of us do that. I mean, maybe not all of you do, but, you know, I think nothing of it. The way I just deal with people all over the country, all over the world, all the time. I mean, on a regular basis, pretty much every day, I'm talking to someone I'm talking to people all across the U.S., of course, and the location is less meaningful than it's ever been in human history. As I've been saying for the last 9 years, I've been saying that. Well, I said it a little differently. Geography is less meaningful than it's ever been in human history. Now, how does that impact an asset class that has this old meme about it? What are the 3 most important things about real estate? Location, location, location. Not as much as it used to be. In fact, now, counterintuitively, the better location is not to be in the places that used to be considered well located. It's just interesting how things change over time, right? Because these linear markets are just so much more successful. You look at a market like Florida, for example, and I almost hate to keep using it as an example, but it's such a good example. It is doing so many things right to just attract businesses and attract people. Truly amazing. Truly amazing. It really is. And speaking of languages, it is wonderful how all of you teach me so many things. And I give you just one little example that happened this morning. One of our Empowered Investor Inner Circle members, his name is also Jason, coincidentally. Not me, just another good name, a Jason out there. He's one of our clients and Inner Circle members, and he posts a question about the HCI, the Hartman Comparison Index, my index for valuing real estate, valuing it correctly by asking life's most important question. Compared to what? That's the most important question. And as I was writing a reply in our community forum, in our little social network, it's kind of like a private Facebook group, but it's not on Facebook. And as I was writing a response, I thought of a new way to think of this. Because as we've talked about the HCI and the importance of the Hartman Comparison Index in properly valuing property, one of the mistakes I've pointed out is that most people have this huge blind spot because they're only comparing the value of real estate or housing to one thing, the US dollar. And that is a giant, monumental mistake, especially in an era where the dollar is losing value so quickly. It's just incredible. In my response to Jason, and I haven't fully thought this through yet, but I said, think of the dollar like a language. And you can say the same thing in many different languages and convey the same meaning and get the same result. For example, if you ask someone a question in English or Spanish or Japanese or Russian, you can get the same result, right? You can ask them that question and get the same answer because most languages have all the basic ingredients to do pretty much simple things. Now, interestingly, and if you've ever studied languages, and I have a little bit, I remember I read a fascinating book on languages few years ago. I can't remember the name of it, but it was about the origin of languages. And it's really interesting how some languages hold cultures back because they don't have words to describe enough things. And I would argue that this is one of the reasons that the English-speaking world has had so much progress, is that they have a language that is a thief. The English language is a great thief. I mean, this is my own words here, of course. It just steals words from all these other languages. And if you think about this, right, if you don't have a word to describe something, it's fair to ask, can you even think of it? Can you think of something that you can't label or name? Is that even possible, right? So some languages don't have words to describe some things, especially scientific things. And I would argue that that has held those cultures back because they don't have words to describe certain things. And it's hard to think of something, or maybe impossible, if you don't have a word for it. I don't know. Maybe you can think of it without a word for it. What do you think about that? Go to jasonhartman.com/ask and let me know what you think about it. If you have the words. Okay. And maybe I'm thinking of all this because last night I watched the old movie again. I'm always watch old movies. It's not that old, but old enough. And that was Dead Poets Society. So I was waxing poetic last night and thinking of all these great quotes and poems and song lyrics. And wow, it was such a great movie. And, it was interesting to see Robin Williams, of course, who has since passed away, as you know, and sadly took his own life. And he was talking about the importance of life in that movie. And I'm thinking, wow, it's just amazing to hear those words come out of his mouth, thinking of, what happened 20 some odd years later to him. So very sad. But anyway, that's the thing about languages. But think of the dollar as a language, right? So if the dollar is just one way to express something, and it is, it's one way to value something by comparing the value of something to dollars. Well, what if you used a different currency? Or what if you used a commodity? And that's what the HCI, the Hartman Comparison Index, does. So let's give you a couple examples of that right now. John Burns is out with a new thing. It's a little infographic that's pretty good. And it says construction cost increases year over year as of the third quarter of this year. Okay, so in 1 year, the following things have increased in price by the following amounts, by the following percentages. And there's a little graphic of a house and a bunch of arrows pointing to the items and the price increases in those items. Framing and block. Now, in Florida, they build most houses out of block construction, right? 15.3%. Lumber, we've all heard about lumber, talked about it ad nauseum. Lumber up 57.2%. House wrap. You know that wrap you see on the house as they are constructing it? You see that wrap and it says Tyvek, right? Boy, that company's good at advertising and branding, aren't they? Well, house wrap is up by 8.8%. Electrical and lighting is up by 17.6%. Steel and aluminum are up by 26.8%. Flooring has increased in price by 8.6%. Windows and door trim have increased in price by 15.8%. And a deck, you know, is there a little deck off of that back patio or maybe a front porch? Well, that has increased in cost by 37.9%. Wow! That is expensive. Whoa, big increase. Roofing and shingles is up by 12.1%, insulation 11.7%, drywall 11%, vinyl siding 16.9%, stucco 13.7%, fiber cement siding 9.3%, painting is 11.5% more expensive, plumbing and HVAC up by 13.5%. This is all in 1 year, folks, as the government has been telling us the official inflation rate is, depending on who you ask, 4 or 5%, right? So all of these things are far above the official inflation rate, which would lead us to believe the official inflation rate is bullshit. Okay, appliances are up 7.2%. Foundations and concrete up 11.7%. 1 year. Think about it. All of the homes you own have increased in value. Maybe there's been some appreciation, sure. But just in hard materials cost, when these costs go up, and this is the whole basis of the Hartman Risk Evaluator that I've been teaching people for 17 years now. That's the basis of it. It's packaged commodities investing, right? My trademark term, packaged commodities investing. Also, I call it assembled commodities investing. So, congratulations. The value of the homes you own has increased quite dramatically just because of that. And guess what else? Anti-American leftist hypocrite, Charles Manson lookalike Jack Dorsey. I got to give him a little hard time there, just a little. But, he seems to be right about something because he tweeted that he issues a dire warning about the economy as inflation soars under Biden. But Jack, isn't Biden your boy? I mean, you helped him win the election, if you call it an election. So the article says, it's not just me saying this, leftist Twitter CEO Jack Dorsey warned late Friday that, quote, hyperinflation, unquote, would change life as people know it. It's happening now, and it's going to hit the U.S. Quote, hyperinflation is going to change everything. It's happening, unquote. Dorsey wrote on Twitter, later adding, it will happen in the U.S. soon, and so the world. I don't know, not very good sentence structure, Jack, but okay, we get the idea. Now, What is hyperinflation? It's a fair question. Hyperinflation. There is no real academic definition for hyperinflation, as I've been saying for many, many years, because we've been talking about this for a long time. But some would say it's inflation rate that exceeds 100% annually. So that means the price of something compared to the currency at hand, in our case the dollar, would just double. So, that cup of coffee that is $3 is now $6. That house that's $200,000 is now $400,000, right? But according to Investopedia, their definition of hyperinflation is more extreme. What is hyperinflation? They say hyperinflation is a term to describe rapid, excessive, and out-of-control general price increases in an economy. Well, inflation is a measure of the pace of rising prices for goods and services. Hyperinflation is rapidly rising inflation, typically measuring, are you ready for this? Are you ready for this? Typically measuring more than 50% per month. Ouch. Can you imagine an inflation rate compounding? Remember, inflation compounds at 50% per month. So prices go up by another half every single month, and the following month they compound on the prior month by half again. I mean, whoa, yikes. Here's a little video from their website that describes it. Of course, you're not seeing the video, you're going to hear the audio, but here it is. It's really short.
Hyperinflation is an economic term describing rapid, uncontrolled price increases. During periods of hyperinflation, the real value of domestic currency erodes at a rapid rate. Prices increase as people who hold the currency seek to get rid of it as quickly as possible.
Okay, super important point there, and that's what happened in Weimar Germany. It happens pretty much anywhere. People hold the currency, and in an inflationary environment, they want to spend. It's like my mom used to say about me when I was a kid. Jason, it's like your money is burning a hole in your pocket. You don't have to spend it now. Well, maybe I understood inflation better than she did. It's possible, Mom, if you're listening. I remember you used to say to me, you spend money like it's going out of style. And it is going out of style, clearly, because inflation is making it go out of style. But it's kind of funny. I mean, according to my mom and my grandmother, I was that way as a kid. I liked to spend money, but now I'm fairly conservative. So, I don't know. Anyway, maybe we become a little different as we grow up and become adults. But people want to spend the money. Why? What they're really saying there is they want to trade the devaluing money, the money declining in value, for commodities that are not attached to any one currency. They have intrinsic value. The paper currency doesn't have intrinsic value. But if you trade it for example, any of those construction materials that I just mentioned as we reviewed their price increases over the past year, if you trade it for those things have intrinsic value. And everybody on earth needs them. Because what does everybody need? Food, clothing, and shelter. Yes, let them rent that shelter from you, ladies and gentlemen. That's the deal right there, shelter. And those ingredients build shelter, so they have intrinsic value regardless of what currency they are being traded in. So the currency will fluctuate. It will lose value. But the commodity holds and stores wealth. One of the many reasons income property is such a fantastic investment. Not to mention inflation-induced debt destruction, of course. Okay, let's go back.
Because they know that the cash will not purchase as many goods tomorrow as it does today. One cause of hyperinflation.
A lot of sound effects in this video, by the way. It's like those dollars whooshing out.
Is when, during a depression, the money supply expands rapidly without a corresponding economic expansion. This creates a large supply of money with little demand for it. The currency then loses its value. Hyperinflation is also caused by political instability and war. Currency loses value because people lose confidence in the government that backs it. Some people even switch to a more stable currency from another country. Sellers require a risk premium to be enticed to accept the currency. The risk premium is reflected in higher prices. A number of countries have experienced hyperinflation throughout their history, including Brazil, China, France, Greece, and Poland. In 1994, Brazil had an inflation rate over 2,000%.
Can you imagine that? I mean, that was only in 1994. That was less than 30 years ago. 2,000% inflation in a year. Most people totally, terribly, tragically impoverished by that, but some people enriched by it. It's a wealth transfer. And keep listening to me and keep buying properties at jasonhartman.com/properties, because I will help you be enriched by the inflation rather than be the victim of it.
One of the most famous periods of hyperinflation was in Germany during the early 1920s, when hyperinflation reached a peak of almost 30,000%.
So that was Weimar Germany, and battling those World War I reparations and so forth. 30,000% inflation in a year. Can you imagine? Well, without further ado, we better get to our guest. We've got John Hyre back today for more as we talk about retirement plans. And also, I can't say mark your calendar yet because we haven't totally set the date on this, but we will have, before the end of the year, a virtual event coming up again. And this will be a virtual one. We had our live one, last month, but our virtual event will be Creating Wealth. And that is a program that I've had, so many people come through over the years. I've got a box of testimonials from that event, and we're going to do it on Zoom coming up soon. So look for that announcement and attend. It'll be very, very affordable, and we want to help you battle inflation in more ways than one, see? So we'll be announcing that soon, so stay tuned for that. But now, let's get to our guest. The dominoes are staggering from this. I don't know how much money that is, but it would have just huge effects that would just ripple throughout the economy.
The custodians, for obvious reasons, because it would put a lot of them out of business, and I would say at a minimum, cut their revenue in half at a minimum. The self-directed custodians are in the fight, but what really is needed are the stories. That's what appeals to the sorts of people who are the decision makers right now. They need to understand, both from what you just said, look, you don't understand the ripple effect on the economy. People raise a lot of money from this, but especially the sympathetic story of the individuals who are like, wait a minute, I played by the rules and I invest in things that are both profitable, and I hate to use the term, but one must play the game, socially just. Because you got to speak to that. You want something, you got to speak to those people in their language. It's a massive, massive impact. And again, they just slipped it in a few little paragraphs, hidden in 800 pages. That's how they play the game.
You know what they say, John? We've got to pass the bill to read what's in it.
Yeah, that sounds familiar.
Harkening back to Nancy Pelosi. It's just unbelievable. Oh, God. You just can't write fiction this good, can you? Let's switch gears as we wrap it up here and just share some of your great knowledge with us. Teach our investors something. We've got lots of people listening who like to buy, mostly single family homes directly, mostly not in any kind of fund or syndication or anything. What are just some tips that you want to share with our people?
Obviously, I like running things through self-directed accounts. Some people say you should never run rentals through self-directed accounts because you're losing a tax benefit. It's inferior logic, right? The account has a certain amount of money in it. Ultimately, you're going to run out of depreciation and loan interest deductions and so on. So I think it's a silly argument, but that's one of my first. Of course, you guys know about cost segregation studies. If you're going to do a long-term hold, I'm a big fan of cost seg. Good news is right now, there's no proposal to eliminate 1031, and there's no proposal to eliminate stepped-up basis. So the whole 1031 until you die concept still works. Yep. Here's one that a lot of people miss. You are able, there's an election you make. to write off $2,500 or lower invoices. And a lot of accountants underutilize that on rentals. Now, I've seen a few overdo it. Some of the accountants will only apply that to things you can normally write off as an expense. But the way I read the regulation is this applies against capital items. So if I'm doing a rehab, some portion of the rehab where the invoices are under $2,500, I think I can write off immediately using this rule. Now, some people get stupid. They do a $40,000 rehab and say, I need, what is it, $2,500 invoices. So
okay, so let me just explain what I think you're saying to everybody. Instead of making it a cap X, which means you have to depreciate it over a longer schedule, you make it an expense. Mm-hmm. So it's deductible in the year paid, right?
Yeah.
Okay.
And there's greater ability to do that than people think. It's a subtlety. There's also a subtlety to how far do we push it, right? Little pigs get fat, big hogs get slaughtered. Opportunity zone funds are still a thing. They have not gone after them at all. The key is finding a deal in an opportunity zone where you're either going to do new build or you're going to rehab such that the rehab cost equals the cost of the building. To give a simple example, $100,000 property, 20,000's land, 80,000's building. I got to either do a new build or I got to rehab 80,000 of the existing structure. We see this on self-storage, mobile home parks, residential, lots of it in Puerto Rico, hotels and so on. And what's the benefit of the Opportunity Zone Fund? The little benefit is deferral of the capital gains till 2026. And if you look, the proposed increase in capital gains rates is fairly modest. It's not as big as we feared it would be. The net present value of deferring capital gains to 2026 is greater than a 5% increase in cap gains. So the deferral doesn't scare us. It's the small benefit. The big benefit is, I call it the J-Lo benefit, a great, big, beautiful back end. Once the Opportunity Fund turns 10, its properties can be sold tax-free, including no depreciation recapture. Yeah. And you can set up your own fund. It's not hard to do, or you can invest in one. People, I think, are underutilizing those. Now, it takes work. You got to be willing to rehab or build.
We've done a lot of shows about opportunity zone stuff, John. And, you know, we have honestly not been too impressed by the opportunity zone discussion. But, you know, I get that people go after it and they like it. I think a lot of these funds will get caught in timing problems and so anyway,
how much discussion is there of people doing their own little fund? I mean, we have people setting funds up with $100,000 and doing it themselves. Usually it's people who are already good at rehabbing and building or delegating the same thing.
Yeah, I mean, basically you have to be a developer. Okay. You know, that's who it's for, I think.
Yeah, you need to be good at those things or find someone to delegate. I'm not really impressed with the funds that are out there for me to invest in. Now, there are a few small private ones I like, but I'm a big fan of my clients who are already doing this stuff. They're already into those areas. They're already into rehabbing. This is crazy, stupid, excellent for them.
Yeah.
That was my other list of items, just a brief rundown. C corporations are becoming more of an arbitrage opportunity, especially for a rental management company for people with high incomes. Why? It looks like they're going to reduce the rate to 18% if the C Corp makes $400,000 or less. Keep it at 21% for C Corps that are making $5 million or less, and foolishly, I think, raise it to 26.5% for C Corps that make $5 million or more. So I think that makes us less competitive.
Yeah, we'll incentivize all the companies to keep the money offshore instead of bringing it back.
Well, and that's why they're doing that tax compact. They're trying to take the incentive away by making sure all jurisdictions screw us equally.
Right. Yeah.
I don't know how many of your guys do Airbnbs. My favorite technique there, hold the Airbnb, assuming you're actually owning the property versus doing a master lease or a sublease. Mm-hmm. Hold the master property in an LLC, sublease it to typically an S-Corp, maybe a C-Corp, depending on what's on your tax return. That way we preserve some rental, because most Airbnb income is treated like normal income. As if you had a hotel subject to Social Security tax and so forth.
Because they're staying less than 28 days, I think it is, and that makes it a hotel, not a rental property. So that's not passive income, right?
That's roughly correct. The rules are a little more complex than that. I can go there if you want.
Yeah, they always are. I'd like to delve more into the C-Corp discussion, because you mentioned it on Airbnb and also on property management. So how does someone use a C-Corp? Most people think about an S-Corp or an LLC treated under subchapter S. And what that means is that all of the income passes through to your personal tax return. So it's only taxed one time. But with a C-Corp, you have double dipping because the corporation is taxed at the corporate level. And then when distributions are taken, you're taxed at a personal level. Most mom and pop type operators, they're not looking at C corporations, but you're saying it's back in vogue because there's some arbitrage opportunity. Explain that to us if you would. You said property management. So, for example, you've got an investor listening to this now. Maybe they own 20 single-family homes. Would they set up like their own property management company as a C Corp or something? Or what are you saying there?
Let's talk about this. So property management company, A, do we do it for asset protection purposes? Rarely if mom and pop are the sole managers, because a corporation or an LLC will protect you from the actions of others, contractors, partners, employees, but they rarely protect you from your own actions. So if all the action is you, I think a separate management company for asset protection doesn't make a lot of sense. Now, once you got others involved, I think it makes an awful lot of sense to try and insulate things. So that's the asset protection angle. On the tax side, you're going to use an S-Corp if you're low to mid bracket. The biggest advantage of a C-Corp is the arbitrage. If I'm in a 39% bracket and the C-Corp's getting taxed at 18%, and I can keep the money in the C corporation, that starts to make a lot of sense. Well, what does it take to be in the 39% bracket? Probably about $500,000 married filing joint. So it's for higher income types that makes the most sense. Could it make sense at lower levels? Sometimes. Usually my rule of thumb, and it's just this, it's a rule of thumb. If you're showing from all sources on your 1040 taxable income of about 400 or greater, a C corporation to play tax arbitrage may make sense for you. In other words, I'm only paying the 18 or 21%. Now, eventually I have to take it out. The object is to delay that dark day, to play certain games, to take the money out tax-free as much as possible. And for example, to have the use of the money. I'll give you an example. Before I came to Puerto Rico and made this all irrelevant for me personally, I thought about having my tax practice in an S-Corp and my information marketing in a C-Corp. And the C-Corp would accumulate at a different bracket. And also remember that once you hit certain levels on your return, especially if some of this legislation passes, right around $400,000 on your return, bad things start to happen in addition to higher brackets. A lot of limitations and such kick in. This keeps your 1040 low. It's kind of like a halfway IRA. You got to keep the money in the C-Corp as long as possible to benefit. There are ways to indirectly access the money. By far, my favorite, is a bona fide legitimate mortgage loan to acquire rental properties. My information practice accumulates a bunch of money in the C-Corp and it's got excess funds. So it lends it to me, because this isn't an IRA, so I don't have prohibited transaction rules. It lends it to me on a 30-year note with maybe a 10-year balloon. So 30-year AM, 10-year balloon, regular monthly payments, commercial interest rate. I would probably photocopy a bank document and modify it. The more your loan looks like the bank, the less likely the IRS is going to say, this is a disguised dividend and we're going to tax you. That's what you don't want. You want them to look at it and say, no, that's an honest to God real loan. So these kinds of games, but it's primarily the arbitrage for high income people.
Okay, so the C-Corp thing, if someone's making over $500,000 a year, that's married, right?
Yeah.
What about single? Is it a lower number?
Yeah, probably closer to 300, 350.
Okay, so you're not sure the number, but you assume it's lower, right? Which is probably a fair assumption. Okay, so if they're making single person above 300, 350, married above 500, then setting up a C-Corp to be kind of your own property management company for your portfolio could be a good idea, right?
Could make a lot of sense. And there are other,
Well, just 1 second about that, though. So the money comes into the C-Corp. Do you leave all of that rental income in that C-Corp, right? So if you've got $20,000 a month in rental income, it goes into the bank account of that C-Corp, that management company, and it just stays there, right?
Actually, that's a great point. Really important that you treat your rental management company like a normal real one. You pretend you're dealing with not you.
Okay.
And that takes work.
So you just take a percentage of the rent then?
Of course, yeah. It has to be a reasonable fee based on market conditions.
Fair enough.
There should be a written contract that's followed.
Okay. That company, that C-Corp's only going to retain a percentage of the rent. Say you can, get away with 10% plus nickel and diming for this, that, and the other thing, just like property managers do in real life, which is why I think people should be self-managing more often. So that money is insulated in the C-Corp, and it's paying the lower tax rate. But what do you do with it? You just keep it in there, you pay expenses out of it, or just build wealth through that company alone?
It's usually build wealth through that company, or once you have a critical mass enough to make a proper loan on a rental property, use it to finance one of the rental properties at surplus. That's how we usually do it with the property management companies. And just a hint for your people who are not just real estate investors, this is much more common. For example, let's say we have a dentist who has 3 offices and they've got really good income. We might put one of the offices, and what the practice, not the literal real estate, into a C-Corp to shelter that. And that's a much larger sum. But for real estate investors, it's funny, I was doing research. There's an outfit that puts out really high quality continuing legal ed for people who deal with very wealthy clients. And what their favorite technique with very wealthy clients, we're talking people who own skyscrapers in LA, is to have a C-Corp that you can run defined benefit plans through, for example. So that's another opportunity. I mean, if we can set up a defined benefit plan for a management company, if it generates enough income, that's going to be the key. We can contribute in some cases $300,000 a year, tax deductible, to the defined benefit plan. Now, size matters. Are all the landlords, is that going to be attractive? No, and that's where we get into the income thresholds.
Sure.
And like you're saying, how much money can we funnel? Maybe we started as an S-Corp and do something more modest like fund 401ks and other benefits. No income tax bracket arbitrage, but allows us to do a few other things.
Right.
And then once you're making enough, we start playing the arbitrage game.
Okay. So what were you going to say before that? You were talking about the C-Corp thing. And
I was going to go on to, they have a provision that if you have an S corporation that's old, roughly 1997 or older, you're allowed to convert it to an LLC tax-free. That's a big deal. That's a very big deal, because anytime you pull property out of an S-Corp, it's treated like a sale. For example, you have a rental property in an S-Corp, which is normally a huge mistake and not something you would normally do. Usually it's an involuntary rental. Someone meant to flip it, couldn't, so they rented it. And then they call me and say, John, I deeded the property into my own personal name for 20 minutes. The bank said I would get a better rate on the property if the property were in my name. So I deeded it to me for 20 minutes, and then I put it back in the S-Corp. Oh, sorry, if the IRS audits, they treat that as a sale. So anytime you remove any property from an S-Corp or a C-Corp, for any reason, you change the name on the deed, the IRS gets to treat it under tax law as a taxable sale. Real tax, phantom income.
Really?
Yeah. Yep.
I mean, that wouldn't just be considered if it's a single member LLC.
If it's taxed as an S or a C, then it's considered a taxable sale. And why? Well, Congress said so. So we've had that situation where people have done that. So first, what's the lesson? Think twice before you put any property. Even like if you have a dentist's office, for example, putting property into the S-Corp, you might have a separate LLC that rents it to the S-Corp. You really want to think about that.
Well, most people aren't using corporations, though. They're using LLCs.
Well, LLCs taxed as a corporation is the same thing.
Right.
Right. So if you have an S-Corp or an LLC taxed as an S-Corp, it's the same thing. Now, to hold the rentals, most people know you're supposed to use LLCs. But we have seen a surprising number of people put rentals into S-Corps, or more commonly, they intended to flip and they couldn't and ended up with a bunch of rentals in an S-Corp. We've seen that a good bit. So what's the good news? If you have an old S-Corp, because normally when you convert an S-Corp to an LLC, the IRS pretends you sold all the S-Corp's assets at fair market value, even though you didn't, which is a huge disincentive to make that conversion. What they're saying is with old S corporations, there's a specific date. I think it's May 13th, 1997. If you have an S corp, you can convert that to a regular LLC. So it's a small category, but for those people to whom it matters a lot for the ones that want out of the S corp format. I mean, you've got your classics. You pay the kids, you structure vacations to be tax deductible, the Augusta Rule where you rent your house so you typically your S-Corp or your management company, those sorts of things.
That's the Augusta Rule?
Yeah, the Augusta rule is you can rent your personal residence up to 14 days a year tax-free.
Okay.
And they call it the Augusta rule because on that golf course, they get some stupid amount of money, like, I don't know, 10 grand a day or something. And so they get to keep that tax-free. So we just put a little tweak on it. We rent our personal residence to our business 14 days a year. And so the business cuts a check for the rent, gets a deduction, but it's not taxable to me personally, as long as I do it 14 days or less. And we can argue over how much the rent should be. I think the key is you actually have to do something. An annual meeting, in my case, client meetings where we happen to have a lot of bourbon and rye, or sometimes we have rye and then bourbon. I mean, I am like into diversity. So, but you actually do something, it's not just on paper. That's a very easy deduction to generate. Yeah. So that's the Augusta rule. Very, very popular. I mean, it's not a secret, but it's one of my favorites because I'm shocked at how few people know about that one. And then last but not least, because you said just point out a few of my favorite rules and things to play with. We're seeing in this market when people start running out of depreciation and interest deductions and that net rental income starts becoming taxable. So usually for later in life, we're just seeing people buy high-end properties that break even on cash flow, but given the market, inflation, economics, regulation, they continue to appreciate. And it throws off an awful lot of excess depreciation to shelter all those other properties that lost their depreciation or you paid off the debt. Yeah. So we're seeing more of a move in that direction. And they're easier to manage too. I mean, I've managed low income. That's something else. Yeah.
Yeah. No, we like the class A or B high quality rental properties. That's what our clients tend to do best with. So I hear you. Good stuff. Well, John, give out your website and a fascinating discussion. There's so much we could talk about. This is just like this never ending field, right? As you well know, but give out your site so people can learn more about you.
Okay. So my personal website, if you go to Tax Reduction Lawyer or taxreductionclass.com, and one's the practice and one's the info product, Tax Reduction Lawyer or taxreductionclass.com. And then, even more important, frankly, handsofmyira.com. Please just take the time, take the template letter, write out your story, send it in, and let us stay in touch because there'll be inflection points where it matters. When they're getting ready to vote, when they're getting ready to do amendments, when it goes to the Senate, there are going to be inflection points where we ask you to do it again.
Well, John Hyre, thank you so much for joining us today and sharing some of your wisdom. We really appreciate it. And let's keep our fingers crossed that this disastrous legislation does not unfold.
I appreciate you helping share it, the message. Yeah. I really do.
Absolutely. Thanks again.
So George Gammon, Jason Hartman, and we've created a high-level mastermind group called The Collective. The goal of The Collective is for you to learn from the three of us, as well as, of course, the other members, on how to build and, more importantly, how to maintain your wealth. In this video, we're going to go into detail about what The Collective is and what it can do for you. Enjoy. So I'm Ken McElroy. I've been in real estate for over 30 years. Started with a 2-bedroom, 2-bath using my own money, and now I own over $1 billion worth of real estate that I bought over the years, built a big company. We have a construction company, a development company, a property management company, and of course an investment company. And typically now we syndicate and work with large, both private and public institutions for the equity and the debt. And so what I bring to The Collective is how to scale, how to grow, starting with one really small property with no experience at all and growing it into an organization, which I've been able to do that basically runs almost without me. So that's what I'm going to bring to The Collective. We decided to start The Collective because, one, I met George Gammon, and George brings a very interesting perspective about the economy and the Fed and the way money works and Bitcoin and alternative types of investments, which quite honestly, I was super focused on real estate almost the entire time. And even I want to be a little bit more diverse. So when I talk to George and to Jason, they're always doing very, very different things on the investment side. Jason specifically is more focused on the single family housing and what's going on in that market so that we could collaborate and have different viewpoints on different things. And so that's why I thought the collective would be good, because I think everybody's kind of searching for the same kinds of answers. So the collective means to me basically the collective group, the whole. And I've always been a big believer of team and collaboration. So for me, it really means collaboration of everyone kind of coming into a room and learning from each other based on their individual highs and their individual lows, and to be very, very respectful of all their independent views on things, and to be more open-minded, transparent, and authentic. So I cannot wait for the group to get together each and every quarter, because we all have very different walks of life that we're going through, and so it's very, very cool to get into one room with like-minded people. I think the right person for the collective is somebody who's into personal development, somebody who's trying to be a better individual, somebody who's trying to have that work-life balance, trying to figure out good decision-making on the investment side specifically, good decision-making on the personal side perhaps, certainly on their health and on their wealth. The members that have already signed up are people typically that have businesses that they're growing, businesses that they've started, or businesses that they've sold. So typically they're higher net worth and they're trying to figure out what to do with their money. They're probably a little bit afraid of inflation. They're probably a little bit concerned about where to invest. And they're obviously looking at real estate as one component, somebody that's trying to do the right things both on the personal side and on the financial side. So some of the experiences that members can expect to get out of the collective are certainly the network. And I think that's always super powerful. I've been involved in groups like this before, like EO and YPO, the Entrepreneurs Organization, and YPO, which is Young Presidents Organization, which is kind of a peer-to-peer network. And that's what I envisioned, and I think people are gonna certainly get that out of there. They're gonna have lifelong friends for sure from this, and they're gonna meet people at every single event. But also, we're gonna have fun. So as an example, things like race car driving and doing all kinds of really cool things and meeting celebrities and things like that, and fashion shows are gonna be part of it. So it's kind of a, how do we have fun and learn together? And we're gonna have that at each and every event. So thanks for watching. If you guys are interested, there's a link below you can click on. It'll take you right to the website, which has a load of information on exactly what the collective is, where the next events are, and what exactly you'll be getting if you become a member. Thanks for watching.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.